Morning, everybody. Happy Wednesday. 30.39. Remember, that's our old closing high, just shy of that, but kind of an indeterminate open this morning here. If you take a look here, remember our leadership for the month. Actually, healthcare's done very well. Utilities have lagged. Tech's done pretty well, particularly semis for the month here. Banks have done exceptionally well. That's a market leader. Yield curve really helping that. Consumer staples actually are down. So this is sort of indeterminate trading, I would say. Keep your eye on the big picture, though, the trend. First thing about October is no blow-ups. So take a look at our month for October here. It's been basically a slow melt-up, despite the fact that we had a little bit of chaos here around trade issues and tariffs. It's been a slow melt-up here. And again, we're just off the historic highs. The other thing that's important is we're getting some rotation, and that's why the market is holding up so well. And that's what's kept us generally in the green all throughout the year. So take a look. Banks. Hey, the Fed's helped here. We've got a higher yields and a generally steeper yield curve for the month. That's helping the banks. Healthcare, which is a defensive group, up. Tech's help, particularly semiconductors. So you got defensive as well as cyclical sector that are up here. And the old leadership groups, defensive stocks, consumer staples, and utilities are actually down this month. So we are getting a little rotation that's really helping the market. I think that's extremely healthy for what's been going on here. So if you take a look here, what am I worried about? Complacency. I have been complaining for weeks about the volumes. It's terrible. ETF volumes are below normal. General equity volumes are below normal. Even options is below normal trading. Nobody is out doing a lot and committing a lot. Generally, we're moving up on lack of selling, not enthusiastic buying, and that's an important mindset difference. The VIX is at 13. That may be an obvious reason. There's not a lot of reasons to trade, but call ratio has generally been low. That means traders are not going out and trying to buy protection for the market. They're not terribly worried. This is classic complacency. So the market is kind of like a coiled spring right now. It could be sensitive to any kind of thing that would move it a little bit to the downside, like, for example, the Fed coming out and trying to imply we're done for the year. We're not going to do anything else. So that's why there's a little bit of risk to the market. Obviously, the Federal Reserve has helped. They've been buying those short-term treasuries again. That's been helping the yield curve. But we want to know what the direction is. What are they going to be doing? And that's what we're going to hear about today. Remember the old Fed statement and what their last committee statement was? The committee contemplates the future path of the target range for the Fed fund rate. It will continue to monitor the implications of income of information for the economic outlook and will act as appropriate to sustain the expansion. That's the key phrase. We'll look to see if they change that. We're looking for any indication that this is through and done at this point and how the market might react to that. And as I said, guys, the coiled spring idea, the complacency is very, very high right now. So the market is vulnerable to some short-term shocks, and it could come from the Federal Reserve.